Hi everybody, my name is David. I am first year student in MBA ITB. Through this video, I will explain about the economics of taxation. Okay, let me start. Enjoy! Taxation is any compulsory levy from individuals, households, and firms to central or local government. The economy imposes a wide range of taxes on people. Most taxes are levied on measurable economic flows. For example, a profit or net income. Tax is levied on the annual profit earned by corporations. The system is always evolving as the government seeks to develop and maintain a tax system that meets objectives and targets. So, why do we need to pay taxes? Taxes intended to raise revenue to finance spending on goods and services by central and local government. The government, when managing the level of aggregate demand output and prices, use taxation. When demand is perceived as being too strong, the government can increase direct taxation to reduce the level of real disposable income and household spending. Tax can correct for externalities and other forms of market value, such as monopoly. Import taxes may counter imports and therefore help the country's international balance of payments and protect industries from overseas competition. When an excise tax is imposed on the sale of a product, the cost of the product to the consumer rises, and the price received by the producer falls. The spread between the consumer's price and the producer's receipt equals the tax. At the higher price, the consumer will wish to buy less of the product. At the lower price to the producer will wish to produce less. The quantity of production declines. If a tax is removed on a product, the price paid by the consumer falls and the price received by the producer increases. Output and consumption of the product will increase. The price changes and resulting change in output are the excise effect of a tax. The tax rates that matter are the marginal tax rate, the tax that would be imposed on the next unit of activity. Marginal tax rate governs the choice between working longer or taking more leisure, and between consuming more or saving more. In a tax system with exemptions and several tax brackets, marginal tax rate may be much higher than average tax rate, and average tax rate rise with income. When marginal tax rates are graduated, they act as a set of escalating excise taxes that ultimately choke off effort. The higher one's productivity and income, the higher is the tax rate applied to an additional dollar of income, and the greater the discouragement of added effort. Changes in marginal tax rate affect the economy by changing two very important relative prices: the price of labor versus leisure, and the price of saving and investing versus consumption. Higher marginal tax rate on wage rise the price in terms of hours of work of obtaining market goods and services relative to the price of an hour leisure. Such tax increases rise the cost of labor to business and discourage work effort by individuals. Higher marginal tax rate on income from saving rise the cost in terms of how much current consumption must be given up of obtaining additional future income or future consumption. This discourages saving and encourages current consumption. An important feature of tax system is the percentage of the tax burden as it relates to income or consumption. The terms progressive, regressive, and proportional are used to describe the way the rate progress from low to high, from high to low, or proportionally. Generally, Indirect taxes are seen as regressive. The proportion of income paid in tax decreases as income rises. Direct taxes are progressive because the proportion of income paid in tax increases as income rises. With a progressive tax, the marginal rate of tax exceeds the average rate of tax. As a result, progressive tax has to reduce inequalities in the distribution of income. The post-tax distribution of income will be less dispersed than the pre-tax distribution. With a proportional tax, the proportion of income paid in tax remains constant as income changes. Now the question, who pays the income tax, the payroll tax, the estate and gift taxes? Who bears the burden of the gasoline of tobacco taxes? If Congress were to raise this tax rate or lower that tax deduction, who would gain and who would lose? This burden or incidence of a tax refers to the change in real incomes that results from the imposition of a change in a tax. In this explanation, this definition distinguishes between the terms incident and burden. Incident is defined as the partial on-market economic effects of the tax, which may also be thought of as partial equilibrium analysis, while burden is defined as the general equilibrium economic results involving all markets. A better understanding of the economic consequences and real burdens of taxation is indispensable to achieving an optimal tax system, one that minimizes the economic and social damage associated with financing government outlays. How buyers and sellers share the initial incidence of a tax depends on the market behavior. The portion of the tax presumed to be paid by the buyer or the seller varies depending on the responsiveness of the demand for and the supply of the product or input as the price changes. In the chart, this is reflected in the steepness of the demand and supply curves. With a tax on firms of $T per unit of labor hired, the market will adjust, shifting the tax partially to workers. When the tax is levied, firms must first pay WO plus T. This reduces the labor demand to LD. The result is excess supply, which pushes wage down to W1 and passes some of the burden of the tax onto workers. Excess burden or deadweight loss is the additional cost of raising a given revenue through distortionary taxation as compared with a poll tax yielding equal revenue. US studies suggest excess burden is approximately 20 to 30 cents per dollar rise in taxation, illustrated by partial equilibrium supply and demand diagrams, assuming, for simplicity, infinite supply elasticity. For example, horizontal supply curve. The diagram illustrates how deadweight loss rises with the square of the tax rate. DWL with tax at rate T equal D, shaded area is 3 times area D. So total DWL with tax of 2T equal 4D. Okay, that's all my video about the economics of taxation. Thank you very much for your attention. See you and bye.